Introduction to Perfect Competition. Okay, so this week and part of next week, we'll be studying about how firms maximize their profits in different market structures. And the main difference between these market structures is the degree of control that the firms in those markets have over the price they charge. Basically, firms can fall into two different categories. The first is they might be a price taker. That is, they must accept the prices set by the market, by supply and demand in the market. Or they can be a price maker, a firm that can set any price they want for their product, regardless of what's going on in the rest of the market. Okay, here's two different examples to start giving you a flavor of what I'm talking about. First, over on the left, the price taker. Last weekend, I was at the farmer's market, and there were numerous stalls selling tomatoes. And at every one of those stalls, charged exactly the same price for their tomatoes. So there you get some sense that these firms were price takers. There was some sort of overall price being set in the market, and they just had to go along with it. On the other hand, over at the right, think about the cell phone market. Different cell phone companies set the price for their product. Apple sets a price for its latest iPhone that's more than the car that I drove when I was in grad school. They can set any price they want there. So that gives you an idea of this distinction we're drawing between being a price taker, where you just have to go along with the market, and being a price maker, where you can set the price for your product. Okay, so here's our four market structures again, and I'm going to show you this table over and over, and I really recommend you use this table when you're studying this material. Go through each section and think very carefully, make notes on each on the entry in each column for the particular market structure we're studying, and that will help you pull everything together for this section of the course. Okay, so we're doing perfect competition in this lecture, where there are a large number of firms producing a homogeneous product that is all firms sell an identical good. And it's easy to enter. Because of those factors, the firm has no control over price. Now you might see already how in my previous example, we're already starting to use the entries in the different columns. One of the reasons that all those farmers at the farmer's market couldn't vary the price of their tomatoes is basically one stall's tomatoes were pretty much like every other stall's tomatoes. They were homogeneous, so the firms didn't have a lot of market power. Okay, once again, I'm going to repeat this because it's important that you understand the characteristics of the market structure. Perfect competition means that there are a large number of independent producers. This means that any individual firm comes up with just an infinitesimal portion of supply. If that firm were to leave the market, no one would notice because there's so many other firms supplying the good. Second characteristic, the products are identical. That means that consumers can't tell the difference between one firm's product and that of the other firms. And finally, there's relatively free entry in the market. Firms that are outside, not producing the good that's traded in this market, can enter the market pretty much anytime they want. All of these factors make firms in a perfectly competitive market price takers. Here's why. If any firm tries to raise its price above the market equilibrium price, no one will buy from it. Why? Because there's plenty of other firms you could buy from. Remember, there are many firms in the market, and this firm only produces a very infinitesimal part of the market production. So that, and also, we have the requirement that in perfect competition, the products are homogeneous. That firm's product is the same as everyone else's. So between the fact that there are plenty of other firms to buy from, and their product looks exactly like the product of the firm that wants to raise its price, why would you pay a higher price? You can go somewhere else, get the same product at the market equilibrium. Therefore, no firm has the power to raise its price above the market equilibrium price. Okay, here's another way of looking at this situation. Remember, in a sense, the firm's demand curve is a horizontal line at the market price. Over at the left, we have the supply and demand curves for the market. There's a market supply curve, a market demand curve that determines the market equilibrium price and the overall quantity. So we've got a price there that's set by the intersection and a quantity that's about 1 million units for the market. Over on the right is kind of the supply curve that an individual producer in this market sees when they look out their front door at what's happening. There's this market price, and that's the only price. They produce about 100 units, so they're small in respect to the rest of the market, and they just have to accept that market price that's set by the intersection of the market supply and demand curve. Now, you remember way back when we were talking about elasticity in the second week, and I said that there's something called an infinitely elastic supply curve. It's a horizontal line like that, where you can sell any quantity you want at a particular price. And I told you at that time that that was only used in a very strange situation that we would talk about later in the course. Well, now is the later in the course. The individual firm faces an infinitely elastic supply curve. They can sell any quantity they want because they're so small compared to the rest of the market, but they can only sell it at the price determined by market supply and demand. Okay, let's make this a little bit more concrete by talking about examples of perfectly competitive markets. Now, the first thing I'm going to say is, in fact, there's no real world market that perfectly fits our definition of the perfectly competitive market. But there are some markets that come close. And most of these markets are markets for what are called commodities, basic goods and materials that are widely used and are not meaningfully differentiated from one another. So they're fairly homogeneous. Here's the classic example of a perfectly competitive quote unquote market. The market for number 2 yellow corn. Number 2 yellow corn is not the type of corn you eat, corn on the cob, or is used for making frozen or canned corn. It's feed corn. It's fed to animals. But what we mean by number 2 yellow corn is that it's feed corn that's been inspected to make sure that it meets certain quality standards. Each kernel is a certain size and weight. It only has a certain level of contaminants. It meets a whole bunch of characteristics. Notice that the fact that this is inspected to meet certain characteristics means that every bushel of number 2 yellow corn is exactly like every other bushel of number 2 yellow corn. That's the whole point of inspecting and giving it the standard. So we have a homogeneous product here. Every bushel of number 2 yellow corn is exactly like every other bushel. Feed corn, like number 2 yellow corn, is produced by thousands of producers around the world. So we've met that other condition for a perfectly competitive market. We have a large number of producers, and no one of them produces any significant component of world supply. So if a single farm goes out of production, it makes no difference to the total supply in the world market. Okay, producers of number 2 yellow corn are price takers. Over on the right there, I have a chart that shows the price of number 2 yellow corn over time from December of 2022 to June of this year. And notice at the bottom it describes it as U.S. maize or corn, number 2 yellow FOB, which means free on board U.S. Gulf ports. So this is sort of the Gulf ports are a big export market of U.S. corn to the world. So the market price at the port before it leaves off to go to Europe or Japan or some other country, there's a price set there at the market. In US dollars per metric ton is the price here. And that is the market price for for number 2 yellow corn. So the international commodity markets, the supply and demand for this feed corn, determine the market price through supply and demand. And these prices are published daily and offered to every grain merchant in the world. So if you're a farmer growing number 2 yellow corn and you want to know if I sell my corn today, you could pull up a chart or a price quote like this. You could find out what the price is that you would get. If you try to charge a higher price at your local grain merchant, they'll tell you, sorry, nope, this is the price. And you'll have to accept it. Now, even the market for number 2 yellow corn, which comes pretty close to being perfectly competitive, isn't quite perfectly competitive. Production isn't quite identical, mainly because there's variation in price by location because of transport costs. So that those prices I showed you were FOB, US Gulf ports, that basically means New Orleans. But there's also a price quoted for Rotterdam in Holland, which is another big port for the European market. And there'll be a price in Japan and the like. So there's some variation that way. So, if you're trying to sell your corn in the US, the price is going to be a little bit different from the price you would get in Rotterdam, solely because of where you're located. So they're not quite identical. The bigger difference between the market for number 2 yellow corn and our hypothetical perfectly competitive market is about entry. Entry in farming is not easy. It costs a lot of money to get into farming. You have to buy the land, you have to buy big expensive equipment like tractors and combines. So you can't just get into farming just at the drop of a hat. However, compared to other industries, like say building automobiles in a factory, it's easier to get into farming than it is to get into the automobile industry. You can ask Elon Musk about that. So entry isn't perfectly easy in the number 2 yellow corn market, but it comes pretty close to our requirement for being in perfect competition. So farmers growing commodities like feed corn, soybeans, etc., are price takers in the world market, as are producers of other commodities, iron ore, bauxite, things like that that are used as inputs in a lot of industrial products. So this is the kind of thing we're talking about in a perfectly competitive market. So in the next lecture, we're going to study about how being a price taker determines the way a firm maximizes profits by studying profit maximization in perfect competition.